Hi, Ryan. It's Grant Abbott speaking. And again, this is just another little session. No doubt you've gone through your notes maybe once or twice, or bits and bobs here and there, and probably also been in the position of doing your assessment, which congratulations, most people have done really well on. So I'm super proud. You're all going down that track, and we're finding that we're getting lots of great questions which we've been answering on the spot. Many of you have started working into the protector, or at least doing the successor director solution, which is crucial. I was just on a call a little while ago. One of our new strategist members who wants to come into our next intake for the SAPEPAA accreditation. And it's worked out they've got $75,000 of work in terms of just successor director solutions with bucket companies, corporate trustees of discretionary trusts, SMSFs, and also trading companies. So it's certainly a good opportunity for them. And I said, look, you guys are miles in front of them. I said, look, just start off doing the successor director, doing the accreditation, and then effectively you're off and running. Laura, if you just want to put your email up, just in case anyone's got further issues that they want to look at. But hopefully you're all enjoying where you're at, and we've got a lot of exciting things coming down the track. I wanted to just to put you here with the launches across Australia. We've just had to put it back a month, as you no doubt. We've got Melbourne in pretty aggressive lockdown. We've got Queensland where we are. We're in a pretty relaxed space, but Sydney's in aggressive lockdown as well. So with SAPEPAA itself, we're looking at a launch with, it's just taken us a while to get bank accounts, believe it or not, because we've got 6 directors. So we need to get them on the relevant bank account. So we then can do the website, then put in membership, which will be either an annual membership or a foundation membership. So you'll have Susanna Bransgrove, one of our directors, and Sally Rourke, one of our directors, writing to you shortly in terms of that membership. The good thing about that is that whether you take the annual or the foundation, they're still finalising the pricing on that, but it's not too expensive. Your certification cost, which is normally $250, will be wrapped up into that first year's membership if you want to do. If you don't want to become a member, which doesn't seem to be pointless, then you'd have to pay extra $250 to certify. But why would you certify for an association to be a member? So expect that. We're hoping it's going to be out September, ideally. I was hoping to go down to Sydney and do a full launch, a media launch for it, but I can't see that's happening for a while. So it'll probably be an online launch, I would expect, in maybe the third week of September or thereabouts. So I'm just going around the SAPEPAA stuff and that mix. So we'll probably be a little bit later on in September for that one. We've got another course coming up. For those of you who've got friends or colleagues who want to go down that track, will be up around late October at this stage. But really, at this point in time, it's important for us to get all of you guys through before we start marketing the next one, which is going to be fairly important for that one. So let's go on. We've talked about all of this. Just one thing I want to point out, because obviously, strategies like the protector, successor director, they're now starting to pick up quite a bit of momentum. So that even if I took you back probably around about maybe 5 or 6 months ago, we're probably here for all of those solutions, but we're starting to move up. And it's important for you to go out and use the tools that, whether it's Tim or obviously Event of Optimum, or certainly with us in terms of the email tools, get them out to your clients, because at some point in time, those sort of strategies, like an SMSF, they're going to become ubiquitous. And then once it goes in there, costs are driven down. So it's really important to get the protectors, to get the business protectors and everything, and run them as hard as you can over the next 18 months to 2 years, because that's where all the value is. And we can see that by 2025, we're probably going to be just up in this space from our perspective. So the sooner you get in and run it really hard before it becomes ubiquitous, or there's, virtually every planner or accountant is offering it, the better, as far as I'm concerned. Would you agree with that one, Michael?
Yeah, 100%, Grant. It's always best to get in early, isn't it? I probably didn't get in as early as I would have liked to on Xero, but now I'm on board. It's the best thing ever.
Yeah, I know. So it's always the way, is that we tend to sit back and relax. But you guys have already made a commitment to be early adopters. But again, without action, it's nice to have the knowledge, but if you don't put it into practice, and more importantly, put it into practice for yourself, which is absolutely crucial. So if you don't do that, obviously the learning's not there. The core areas, we've talked about this before, but whenever I'm talking to a client, and I know Tony and I, we do lots of sessions on behalf of our strategists who've got big clients, and they just don't feel comfortable dealing with them at this stage, so that we come in and deal with them alongside you. But the key issue is, you'll find that your clients are worried about potential litigation, particularly at this current point in time of the economic cycle. It's nice to think that the government is going to open everything up with vaccines, but if you have a look at everything being done overseas, where highly vaccinated, whether it's Chile, Iceland, the UK, which is a good one for us, or Israel, which is very big. Over there, you'll find that cases are still exploding. Hospitalizations are not as extensive, and it's clear that from Israeli data that the COVID jabs wane after 6 months. So we're going to be in this for a while, and if our leaders adopt a zero tolerance, a zero COVID policy, it's not going to work, even if you get 100% of people jabbed, because it's still going to spread. So that really goes back to, again, this litigation issue, the bankruptcy issue. In terms of insolvencies, Mick, what have you noticed around and about?
It's certainly increasing. The activity continues to increase. We're getting a lot of inquiries, and we're starting to build out a number of case files for clients, and I think it will continue. I mean, the noise I'm hearing and seeing is the ATO is starting to go extremely into full-on action in terms of collection action. There's certainly the amount of like letters we're receiving and calls we're receiving, but I'm also hearing that I was speaking to our financier at We Love Loans this week, and he said that even the lenders are now not even touching anything that has ATO debt on it, or the smell of ATO debt. And then, and this is even some of the second and third tier lenders just aren't interested. They're looking for positions to be taken out in it. They're due to the actions the ATO is doing. So, I mean, if you're not protecting your client and taking the right steps now, then you're going to find yourself in problems once you start getting DPNs and statements of claimants, things like that.
Yeah, particularly remember, we've got the protector, we've got the 4-year rule that applies after that, except for the option D that, that there won't be a clawback there if you've priced the market option correctly, which isn't that difficult. On that one, it's quite interesting. I know, just to give you sort of the depth of experience that we have amongst SAPEPAA, amongst Abbott-Family and all the team like your docs. Tony just was involved in an AAT decision. If you want to give a bit of brief background on that, Tony, around, and I'm not sure if you are aware of this, Mike, but in relation to a cash flow bonus. So do you want to give a bit of background on what the result was there, Tony?
Yeah, just in relation to the AAT.
You just need to speak up a bit.
It was a test. Can you hear me now? Because I've got a bad sort of internet connection, because my wife and my daughter are teachers and they're upstairs using it at the same time. So we may drop in and drop out. I'm sorry.
Okay.
Need to kick them off, Tony.
Yeah, exactly. Come on, this is more important, seriously.
But anyway, coming back to this AAT case, this had to do basically with a cash flow boost, all for 20 grand, basically, right? It was a test case. And what it had to do with basically what the ATO were alleging, basically that our clients backdated some documents in terms of a PAYG voluntary agreement, because there was no installment rate listed on this voluntary installment agreement, right? So when you fill out a voluntary, the involuntary installment agreement, I think it is, for PAYG purposes, you have to select a rate, and the rate is usually 20%. Correct me if I'm wrong, Mick, you know?
Yep.
So they didn't fill out that portion of it, but what the ATO allegedly said was basically that the purpose or the motivation behind you, Mr. Taxpayer, of filling out this agreement, you backdated it in order to get what? To get the cash flow boost. Exactly. Yeah. Right. So they disputed that. He lodged in an objection. They refused they declined the objection. And as a result of that, they wanted to test the case out on that basis. So we rolled with punches at the end of the day. We put up a best fight with it. But at the end of it, the commissioner won the case basically on that basis. They the member didn't go to the extent of saying that the accountant was inexperienced, or he didn't roll punches with him, but basically it's just that, you know, as part of filling out the document, you need to put in basically a percentage or an installment rate on that voluntary agreement. So we went down on that one there, and the commissioner won on that. So there's no purpose of appealing it to the federal court, because it's just gonna, you've got no chance of winning it basically. So that was just a snapshot out of it. If you want to go and have a look and read the case, it's listed on the AAT's website. So it's there.
Which is interesting, but I have seen I think we've all seen the commissioner get extremely aggressive over the last probably 2 years, particularly in the SMSF space. You can see with Gnarly, for those of you who haven't seen it, you can get up on our webinars around that Gnarly. He's being increasingly aggressive, investment strategies. And the next one, we've been in touch with them, Section 100A. So we want to make a submission on that. One of the areas that's really important for us at SAPEPAA, so I'm putting my SAPEPAA hat on now, is obviously making submissions. Just on that one, I'll just preempt it, because I know many of you will be coming down the track and obviously becoming SAPEPAA members. One of the issues there is obviously in terms of ethical, you know, what's our ethical and professional standing. And for that one, what we'll be looking at doing for that is, I've got Peter Mamara Stewart, who's put his hand up to lead a group in relation to establishing ethics guidelines for the association. So for anyone else who's keen on that, you know, please feel free to have a chat. I can see young Alora there. Is there any specific reason that you've looked in? And there's Tim God, what a cast of thousands. So thank you very much for everyone.
I just jumped in because I realized that I can't see the chats if people don't have it turned on to everyone. So sorry for bumming.
That's okay. So the key one's obviously the litigation, the 4-year rule. But again, I know Mike and his team at Venom Optum have had a lot of success. The fact that the protector's in makes it a lot easier to negotiate. Bankruptcy, remember, you've got that time anyway. So by the time, even if you get to bankruptcy, go through litigation, if that's where the bankruptcy is going to happen, then there's plenty of time down that track. But as Michael said, just watch out if you've got tax office debts. Family law is a little bit more problematic for a lot of our solutions, because the family law court likes to look through basically everything. But there is, each case will be held on its merits, particularly when we have a look at trusts, etc. Challenging an estate. Obviously, we've talked about family provisions claims, and there's a whole plethora of information around that one. So within those four, the litigation, bankruptcy, family law, challenging an estate, and I'd probably put another one is obviously continuity, which includes succession. When we have a look at that, they're all crucial areas where our castles get attacked. And one of those ones is where our clients fit. When you have a look at the moment, we've talked about it, that there's over $9 trillion in residential property held in individual hands across Australia, which is a lot of exposure. All those homes, etc., effectively up and being exposed from a litigation or even just challenging an estate. So, there's plenty of opportunity there for us, but at some point in time, a lot of the strategies we have will become a lot more ubiquitous. So the first come, first served. And I just hark back to when, way back to 1994, and have a look at audits in SMSFs. Auditors were charging $2,000 to $2,500 to do an audit then. Again, because it was so novel, we're at that early adoption phase now. Of course, it's a lot. Probably, in fact, it should be a lot higher, but it's not the case. So just, again, we're in that really good, unique position for us. We talked about the moat. I'll just go through this. This is what I call the ideal setup for our client, because I know we've got Kerry asked a few questions about bucket companies. So I'll just go through everything and have a look. So the first thing is we've got our family out there, and it's important when you're dealing with this is to become cognizant and aware of the whole family. So it doesn't matter where you're dealing, whether it's at this level, and so you find out about the parents, or if you're dealing with the parents, finding out about all the family. Generally, if Tony and I are doing a moat and castle for clients, we'll add on there that a portion of it should be doing EPOAs and wills for that next generation, because it doesn't make sense once we start to lower that down to actually miss out on a generation. So when we're doing these family provisions, we basically want to do it for all and sundry. So we've got our wills. We've talked about our executors before. With the wills, there was a case that Tony just sent to me, I think last week, where there was a challenge, family provisions challenge for $50,000, and one of the executor was trying to knock that out, or the solicitors for the executor saying it was too small an amount, it was too frivolous, the estate was too small, and effectively the court held that it doesn't matter how big the estate is. The law is the law. You can take an action under family provisions, and as a consequence of that, it means that there is no small quantum, which I thought was quite interesting. So everything we've got in our own name obviously will find its way into the will. Likewise, we don't want to find our SMSF monies going over the wills. For those of you who haven't been on Thursday, I'll be doing a session showing you the difference between SMSF wills, BDBNs, multi-generational pensions, and also testamentary trusts. So that'll go a bit more deep dive. I just wanted to keep a general broad picture there and cover any of your questions. So we've got our executor, we've got our wills. We've still got our assets basically sitting in the name of our clients, which will continue to be the case. I mean, there's nothing we can do about it. Traditionally, you've got obviously the home's going to be in the names of the individual to get that essentially the principal place of residence exemption, although we have developed a trust whereby it can be put in the trust so you can still get that principal place of residence exemption. That'll be coming out when we get our Light Year Docs 2 up and running. Likewise, for residential property investment, a large amount is in individuals' names in order to get the tax deduction or the negative gearing, which is pretty crucial, although with rates these days, it's making it a lot harder. So that there is a lot of exposure from a family law, from a individual perspective litigation, and definitely from family provisions. So having assets in your own name are like the worst case scenario all the way around. If we have a look at these 4 criteria, If you have a look at those and give 2.5 points to each, we'd be down at probably about 1 point having assets in our own name. But from a tax perspective, it's fantastic. So you can't beat that. So we need to blend our family wealth protection along with our tax, which is why the protector and also the business protector is really good. So we've got our little line there, which is the crossing over, and we're now starting to move into our structures. So if I have a look at our existing trading trust or discretionary trust, we're running a business that's got a backup company, and let's face it, these days, if you've got a trading business, obviously the rates on that trading company income are not significant. If it's passive, it goes down to 25%. But importantly, from that perspective, is that bucket company there. If you think the 32.5% tax rate applies for someone on $42,000, the bucket company, and I think Tim might get Tim. Are you there, Mr. Tim?
I am Mr. Grant. Hello,
yeah,
how are you?
So,
Are you, Tony? Hi, everyone.
Yeah, so with the bucket company, obviously with the crazy rates that we have for individuals in Australia, the bucket company really kicks in pretty quickly for most of your clients, I would expect.
100%. Look, this is a subject of another webinar we can all do, investing via trust versus a bucket company. But we've all got clients that are earning on top marginal rates and will be for the next, say, 10 or 15 years. That's where a bucket company is great, because you're paying tax at 25%, get your cash in there, and then what you do, forget investing through a trust with Div 7A loans and all the rest of it, invest in your bucket company. Use your bucket company to buy property, to buy investments, to buy whatever. It's nice and clean and simple. There's no loan accounts and all that sort of rubbish. At the end of the day, you're paying company tax rate on whatever profits or capital gains. Then when your clients want to work a bit less, they mightn't have trading income coming through anymore, just pay fully franked dividends out. Once you've exhausted that, then you move on to converting your super fund to pension phase. To me, a bucket company is the best way to go. Now, if you contrast that to having to, buying growing assets in an investment trust, yes, you save a little bit on CGT, but what's the swings and the roundabouts with Div 7A and the repayments and the loans? And you know what? It's so hard for your clients to understand. Simplicity and bucket companies, 25% tax rate. I love it, Grant.
Yeah, look, one of the key areas about that is the bucket company, the shares should actually be held in that family protection trust or that leading member trust. So you don't want any, again, if you have a look at it, just logically from the picture we've got there, it should tell you. So with the shares, you don't want them over here, because otherwise there's the issue is that you've got those shares that are exposed. Likewise, family provisions, they're exposed. So like the ideal place for if we were setting it up right from scratch, would be to have those shares up in that family protection trust going on. Michael, what do you normally do in that regard?
Sorry, Grant, I was just...
Yeah, so with a bucket company, we've got a trading trust, so we're dumping down profits in there. But as Tim said, over a period of time, we use that as our investment vehicle, our investment company.
100%.
But I'm saying is the shares should be up there. If they're not there at the moment, we need to get the value up in that leading member trust or the family protection trust.
Yeah, 100%. And I agree with and do the same strategy as Tim does. And it's and it becomes even more prevalent when client hits retirement age as well. So you get the benefit of franking credits and things.
The other thing, Grant, which is quite interesting, with people who've got trading companies and the trusts in their own, the shares in their own name, and you can't move it around for CGT, interpose a holding company, so it's free of CGT and stamp duty, between the trading company and mum and dad shareholders at the end, so you can flush the retained profits down to the holding company.
Yeah.
And then you do a protector over the shares that mum and dad have in the holding company.
Yeah,
and
exactly.
The benefit of that is the family protection trust. So what you can then do is now you've got all those profits out into the holding company, and then you set up a secured loan agreement, you loan the working capital back to the trading company, use Michael and Ventum Optimum to register the PPSR registrations, and you are home and hosed.
Yeah, so I think so. And I think the other area that you've heard me speak before is that bucket company, quite apart from the investment, it's also a fantastic vehicle for related party loans, whether it's in that family protection trust, probably not, but particularly around the SMSF. So that if you're looking at building up, remember you can invest in an ETF with a 50% LVR straight from the bucket company, and then you're off and running. So, don't ever forget that. But this seems to me it's a really good, strong structure, and hopefully that's helped you again, Kerry. But the trading trust as well, although you're going to clean it out, and I'm going to ask all you guys a question in a sec. We've got our trading trust, and we've got our our trustee company where shares switched over. So switch it all to that leading member discretionary trust, so that there's that continuity, that succession in there. With that one itself, when we have a look at that trust, it may well have assets in there, which we can switch over to that family protection trust and then lease them back. I did see somewhere, and I've got to do a bit of research, and sorry, I've just been busy building stuff for Mr. Tim on these sub-trusts, which we're going to look at. But
everyone's going to love that, Grant, when that gets released.
I know. So we're getting there. Actually, I might get Mick just to do because you'll probably be more on top of where we're at with light year docs too. Do you want to give a bit of an update on that?
Yep, I've been sitting on the regular dev meetings, and we're quite advanced. I mean, at the moment, we're sort of, so I guess it's like a bit of a factory process. We've been going through and reviewing all of our current documents, reformatting them to go, and they're starting to get coded and put up onto the new document engine. The actual client portal, which is amazing. So there'll be an app that you can have on your phone, your iPad or your PC, that allow to provide human support and interaction between the Lightyear Docs team, and then that also links then into your the actual document engine and delivers the strategies and stuff. And then from all of that, we'll also have API links into XPM, Change GPS, EO, so it'll be a lot more streamlined, straight through processing in relation to what Tim talked about before. So I think we'll have the first iteration out. I was speaking to Ash and the team the other day, end of October. So
that's good.
Yeah,
and for those of you who are our shareholders, and I'll have to get a letter out with Michael soon. You may have seen that Top Docs was sold to Class today for 13 mil.
13 mil.
Yeah. So, and Reckon Docs was sold for 13 mil. So. For those of you who are on our register, it's good that our competitors are suddenly being swept out of the market. So we're all very, very happy with exactly the spot we're in, and particularly because no one else is doing the sort of stuff that we're doing.
Grant, so I've got to go to another meeting. I'm sorry I can't stay,
okay.
But I'll look forward to seeing everyone again online soon.
Okay, BCT, Bucket Company, Tim. See you, buddy.
It's quite exciting, Grant, in terms of what's happened today. I mean, in terms of for shareholders and in the Top Docs space, and because especially with the offering we've got, that's completely different to market, and they're just buying, I guess, document engines and partial legal teams, but we've got a complete solution, not only with our documents, but our strategies, Abbott-Family, EO. Our partner solutions that we bring to the table, and also our member community as well, who keeps adding further value to what our value proposition. So it's exciting, I guess, over the next couple of years, where the whole let's call it the whole group goes.
I know. I've said it before, and for those of you on this session, I mean, you're going to get a bit of an insight run, but I would like all of us to run on the same platforms, ostensibly, and then at some point in time, 2025, I may know, haven't sort of sat back and said otherwise, but, rather than having a trade sale, I'd prefer, depending on what the market's like, to go to an IPO, because I know Michael's done it before. so that we can all go together, which I think is really, because I've had a lot of review of how Stockford fucked up, but there have been other ones that have done really well, and I think there's a really good place for this family wealth protection as a unique offering going down the track. So again, we'll be talking about that a lot more, and and Michael and I will share our vision with that, along with Tim as well. So that's coming down the track. But essentially, when we do go down there, we'd like to see that virtually every client comes on with a moat and castle, and then when we're building the structure, we look at this sort of structure here, where we've got successor directors, leading member. You got your family protection trust, which is mainly investment, etc. You got your leading member trading trust or trading company with your bucket company, and then you've got your leading member SMSF, which has got maybe only 1 or 2 directors in it, because the other people are members, but they've given their EPOA to make things a lot easier. Then flowing out of that, you've obviously got your SMSF wills, your SMSF death benefits trust, and reversionary pensions, which, as I said before, if you haven't blocked away for Thursday, make sure you come on that, because that'll be a bit of a deep dive. So that's essentially where we want to go. Most of you are probably pretty well aware of what the protector is. And again, I think Michael's got, what's the process now for people with PPSR and also loans as well?
Yeah, the best process is in relation to, so we've got a flyer which we can share if anyone hasn't got it, in terms of the process to follow, but is to, once you've got the documents with the client, is to, or we prepare the documents, is to contact us at registrations@eventumoptimum.com.au. Then we can prepare national mortgage forms and any other documents that are required, and we can provide them to you at the same time you get the protector and the rest of the documents executed. Rather than send us executed documents, then we'll say, okay, we've got to create a national mortgage form, do VOIs, which is verification of IDs, client authority forms, and also when we attach the mortgage deed from the protector to the NMC, we actually have to get, I was talking to Tony on text, he sent me a text about 10 o'clock last night, and I was talking to him this morning to get the mortgage deed, because the mortgage deed has to, because it becomes effectively the terms and conditions of the national mortgage form, that each page has to be signed. So rather than going backwards and forwards with your clients, it's best to, let's be proactive, reach out to us, and we can tell you the process, we can provide you that flyer, and then we can try to minimize the amount of client contacts in terms of execution.
Fantastic. And I think that just part of that end, that honestly, when we first rolled it out, it was very tough, but now EO have stepped up to the plate and come to fruition, which is fantastic. So we've obviously got the protector, which you've seen. I've talked about this before. For those of you only just starting off, remember the whole idea is you've got the accreditation. You should be in this phase. You should have built your own moat and castle by now, and set in place, making everything leading member, understanding the leading member, built your own wills with Testamentary Trusts, but hopefully you haven't got much sitting in there. And I'm going to be looking at life interests shortly. But once you've done your own, it's now time to, as I said, you don't want to sit back and procrastinate, as we all do. Start off with a successor director solution. It is so easy to build. You can build it in a heartbeat, and effectively get that out and get some money in. And then once you've done that, it then starts the philosophy there of that successor director, is that you're there to protect your family's wealth, which is pretty important. So we want to go down that track. One of the ones that I just wanted to show you that we've got, I don't know, I'm not sure if I've showed anyone before. One of the areas that we have built that will come up on the new platform, this is also an important one, that when you're going to your clients, whether it's a successor director, upgrading discretionary trusts, or doing the protector, that if they don't want to go down that track in terms of accepting your advice or putting in place the strategies, then essentially what we want to do is we want to get this client letter of indemnity. this is your protection mechanism. By going through this, you'll find there that it's a good letter. I might get a lawyer, will send it out to you as well as part of I'll put it as part of the notes. But you can change it as you see fit. But the main thing is that, we talk about obviously the asset protection, but in that regard, to protect the advisors and team of Jones accountants, we require you to acknowledge that they provide you with asset protection advice to mitigate the risks outlined above, that you have sought not to take such advice. More importantly, you hereby indemnify, hold harmless Jones accountants' successors and signs against all lawsuits, claims, damages, and demands that arise for not following the advice provided. So that has a threefold impact. First off, it shows your clients that you're taking the advice at a very serious level, that you're only recommending it to them because it has got a significant impact. Secondly, that you have your own asset protection strategies in place, and one of those is a letter of indemnity, and I'm sure that many of your clients, particularly in the professional services area, should be following your suit. And the third one is also that it does actually protect you, because once you've got that indemnity, they can't come back there. So it's a good little tool, and we'll make sure that that's up with the recording as well. Back to the slides. So again, what we want to do is we want to present to the clients on these and then develop the strategy pricing. But if they don't want it, then effectively you want to go in and do that indemnity, which is important. The one that we talked about, this is coming down the track with Tim, working on at the moment, and I think this is a very exciting development where we may have a leading member deed at the moment. And so when we come back here, we should be treating the true reasoning. A lot of this is it's an actual inter vivos estate planning trust, so it's a living trust, so to speak. So what we're doing though is you've got mum and dad, who are obviously the main leading members and succession members, and then from that perspective, once they pass away, what happens is that'll go down. Hold on for a sec. It's like a puppy free-for-all in there. So I had to go and show you one. So we've got the bloodline beneficiaries. We've got the bucket companies that we've talked about there. But once mum and dad go, then we're going down to that next generation. So particularly if these have been set up in South Australia, they go down the track. So at that point in time, we've got a line drawn there. So we need to work out, one is, do we build sub-trusts? And with sub-trusts have their own rules, investment strategies, so on and so forth. Or alternatively, do we actually create a brand new trust, so that if there's an amount sitting in here, for example, for Bruce, remember we looked at this, we could actually establish a brand new leading member trustee. Now, obviously, there may well be capital gains tax consequences in transferring those assets into that existing one, whereas there should not be in that sub-trust. But that's essentially where we're going to. So we're going beyond, we're turning this from a very basic protector style thing to actually being quite a significant element there, so that it may well then flow out of there that each one of these have got their own a line of rules that are going to be important from that perspective. So if we go down, I've got a little, and you can see here the advanced protector there, where we have the property, and as we said, talked about the trading shares, which are really important, but we're essentially gifting everything over, which is fine. So I've got a couple of questions there. We want to carry on for the last 20 minutes or so. Tony, do you want to just sort of have a bit of a chat of some of the stuff that we've been working with some of the advisors around the larger ticket clients and the protector, etc., and the Moat and Castle?
Yeah, so we've got some other big ticket items that we're doing right now with a couple of high net wealth individuals or group families that have got, you know, in excess, you know, 5, 10, $15 million worth of estates. And what we're doing currently now is designing some strategies around that to asset protect them and for their future generations down the line. So it's pretty important to get it right from the outset, and in that sense, it'll protect generation to generation, basically. So it's pretty exciting stuff for us going through that process.
Yeah, so if you want to get in touch with that, if you got like, because I know a lot of people say, look, I'm not quite sure about the moat and castle even when they've done it themselves. Feel free to contact Tony and then, give us one or two of your clients and then we can lead the whole process through. And so you're actually getting a bit of mentoring there as well. So, and there'll be a bit of work involved in there for you as well. Now, I had this question that popped up on life interests that Laura sent to me. So I'll just go through what a life interest is. But the question is, are you able to discuss life interest in the main residence? What happens when person one dies with main residence in person one's name for asset protection purposes? Person two has a life interest in the main residence and sells and wishes to buy another main residence. In whose what name is the new main residence purchased in? What happens to cash left over after the sale and subsequent purchase? So there's actually a lot to unpack in there, which I'll go through. What happens when person one dies with main residence in person's one name for asset protection purposes? Person two has a life interest in main residence, meets a new partner and sells main residence, wishes to buy another main residence with new partner. And whose what name is the new main residence purchased in? What happens to cash left over after the sale and subsequent purchase? So there's a huge amount to unpack there. And really it goes, I'll cover it, but it goes against the grain of our optimal solution. Because again, if we've got the property here that's in our own name, then the value is not in the individual's hands, it's actually over in that family protection trust. So that when we have a look at that family protection trust, and I'll talk about it, that on death, let's say we've got the family home, then on death, the family home can either be transferred in directly to that living trust, and then the next spouse coming in can live in that, subject to the terms and conditions that the trustee puts around that, and then the person after that can live in it, and the person after that. So we've got a lot stronger position there, and more importantly, if we go down this life interest, it's great to have the life interest, but the danger is you can already start to see there's a lot of problems there if, for example, there's a challenge on the estate. Just because you set up a life interest doesn't mean that it is necessarily going to be protected. Family provisions claim may lay that to waste. So when we look at a life interest, and you'll find that when you create a life interest, this is in our wills with testamentary trust. So there's a specific provision in there. So what we have is we've created a will, and in the will there's a life interest. So what will happen there is we've got the legal estate, we've got the executor, so there's probate there. We've got the legal estate in there. What happens with the life interest, Tony, when in between that process? Obviously, if it's in one person's name, in between the process of death and probate, and then subsequent, obviously, potential challenge of the estate. I'm presuming there the partner can stay in it. So it's a de facto life interest until a complete one's been built up.
Yeah, until the family provision claim has been resolved, they can actually stay in there.
Okay, so
pending on what happens, I guess.
Yeah, so it's not a formal; it's more of a leasehold or a de facto leasehold. So normally, what happens is the property will be in the name of the executor, and will always be in the name of the executor as as part of the estate. Then what happens, a trust is set up, and then in the trust we have the property. Now, in that, there'll then be trust rules and beneficiaries. So the actual rules and rules around it and who the beneficiaries are will be enumerated within that life interest. We need to bulk up ours a little bit further, mainly because we go the other way. We obviously look at putting everything over into those family protection trusts. But if you are building this, it's we go out and then you have to find out from the client that first off is that one with that person living in the trust, who the beneficiary is, will it also include their children or the bloodline children? So if we then go down the track, is how long is it for? Is it just for their life, or is it for a set years? What happens if we've got an interest here, for example, that the partner, they get a new partner, is the new partner allowed to live in that environment? If they want to then upsize or downsize, can the proceeds of that property be parlayed into a new property? And does that new property come into that life interest trust? So the new property will actually be owned by the legal estate. So you can see that there's, again, we're building a separate trust, so we need to know how that all fits together and what the terms and conditions are for that life interest. But again, you can see why this is necessary if we've just got it in one person's name and then it flows over to the next person. So that's where the danger is. Whereas if we've got it here, we've got it in that one person's name, but ultimately the underlying equity value, the call options are all over in this living trust, which is just, it means it's not going to be subject to challenge. You're not going to have to worry about doing this quite extensive rules and determination at this point in time. And also goes back to the weakness that I see a lot of ones, and I still do understand that a lot of, for example, the NTAA are saying, well, you should have the spouse in terms of the asset protection for a particular asset. The danger about that one is that by having the assets all in the name of the spouse, you're already behind the 8 ball under family law, because if they leave, then effectively you've got nothing. Do not put anything in the spouse's name unless you've got a binding financial agreement around that.
It's interesting, Grant. I think I learned that going on 23 years ago when I was first in public practice. They should put everything in the non-risk person's name, the spouse's name, whether it's husband or wife. And you know, we talk about continual improvement all the time, and obviously everything that we've got out there is leading market. That you know, you can't keep just sitting on your hands and resting on your laurels and just doing what you've done in the past.
Yeah, and I was so surprised that I was talking to an advisor and I was saying that NTAA is still recommending that. You're thinking, well, it just doesn't make sense because it doesn't pass the muster in terms of family law. It's just very dangerous. Quite apart from the fact, if I go back to this one, let's say that, you know, we've got asset one's got the main residence, so that's what you call the asset protection person. They go out and they jump into bed with a new partner. The tennis coach, they now control the main residence. So they've got full entitlement to kick person 2 out because person 2's absolutely got no rights to that residence whatsoever. And I've seen businesses where shares are actually held by, again, person 1. And again, so the same thing is that person 1, if they want, can effectively just kick out or unemploy or terminate person 2's services. So again, it just doesn't, it makes no logical sense whatsoever why we would have it that way. But anyway, but once we do it that way, then we have to start thinking about these life interest trusts and stuff like that. Whereas here we've got our living trust anyway, that covers us from that perspective. Okay, let's see. So Kerry, I think in respect of bucket companies, who would own the shares, an individual or a trust? Again, it's going to be the trust, as we said before. Definitely a leading member, that family protection or leading member trust. Just as an aside, the only difference between a family protection trust and a leading member one is just simply the name. If a trust owns a bucket company shares, who would you suggest to be the trustee, individual or corporate? Always a corporate, because you want to have that leading member discretionary trustee company, so that if we do have that succession play coming into place, the shares are cancelled and new ones are issued. Would it be a leading member? Yep, that's okay. And the shareholding would be a leading member trust, absolutely. Debbie's got a good question. Can investment or insurance bonds be used within the leading member trust or bucket company? Absolutely. So if you like those as an investment vehicle, that's fine. Just remember they're, depending on what they are, but generally they're wrap-up vehicles. So the tax is paid underneath in the life insurance company, so that when you sell them, effectively it's tax-free. If you have investments or insurance policies or investment bonds outside, you can build testamentary trusts. As I said, we've talked about, and I'll look at this again on Thursday. There's 3 different styles of testamentary trust. There's one that comes from the will, which is fine. But again, if we come from the will, it's going to be subject to obviously a potential challenge there. The same if we put super over into the estate, it's subject to challenge. Whereas we can provide a separate trust, testamentary trust for super, and a separate testamentary trust for life insurance as well. And they sit outside the estate, except potentially in New South Wales. Paul Hopkins, good to hear from you, Paul. A client that has just been through a separation is now looking to purchase a new home. Should this new home be put straight into a family protection trust? Will this help any future wives he may have that leave him in the future? Look, it's always going to be, the best thing to do is, if you want, Paul, you can put it in their own name and do that. Another structure that we've built, and if you have a look at it, is along the lines of having a property. If we have a look here, I'll just put it on this one, so that buying the next property, and this is something to countenance whenever you've done the protector, remember, if you sell this property, then you pay off the bank first, and then you pay off your other financier, which is the protector second. So we may end up putting this or the next house in the family protection trust. And then what we would do is, then it's not going to be a loan. It's going to end up being a 49-year lease. So the value is actually wrapped up in the lease, not so on the property. Now, the reason we do that, there's a guideline from the Commissioner, private binding ruling, saying that when there's a sale, because if you're then going to sell this going on, then you'll receive settlement proceeds for this. Some will go in the family protection trust, but a lot of it will go down to the individual, and then that's not subject to capital gains tax. So there's that issue. Or alternatively, as I said before, you can do that one with Paul. Then it's a matter of if, and we've done this in instances, Paul, if the client is just a bit worried about what's going on, they can put their kids in or someone else in as the leading member in that instance as well. So that'll give them a bit of coverage. From Grace, good to see you, Grace. Grant, could you please go through practical steps post-death of a leading member? For example, if a farmer owns land in his own name, is the leading member with land promised across to family protection trust, and subsequently dies. His wife, as a secondary leading member, has no land in her name. Farmer's will transfers the land to his wife on death. Okay, so that's a really good question. So let me just go back to where we were before. So if we've got the gift over and the farm, so on death, what will happen there is that the family protection trust will be owed an amount of money. That's as part of the protector. Now, if we go down that track, ordinarily what should happen is that the farm itself, and which is why we have the call option, would find its way into this family protection trust. So then the spouse, as I said before, the spouse could then live in it. Now, because it's coming out of an estate, there will be, well, there won't be any CGT, mainly because it's been a principal place of residence. So we can shift that over. That will now find its way there. And you don't want to the business won't transfer over, so you'll probably still have, if you're running the farm, it can be run separately through individuals, or it may well be in that leading member discretionary trust. So that's the way that it will flow over. So for the loan, effectively will be extinguished for the transfer of the property over. And we'll just have to look at, obviously, stamp duty around that particular issue. But it means now that property sits in not only for that generation, but generations to come. And that will then protect it from a family law perspective when it comes down to next generations, etc. So that's probably the best way to do. John Stitt, in your examples, person 2 would have to be an executor of person 1, otherwise they'd have no power to sell the house they have a life interest in. Absolutely. Usually they can direct. It depends on the way that you do it in the trust. So what we're doing is we're looking at this leading member trust. Essentially, so let me just get this one. So when we have a look at that, absolutely right, John, is that with the rules and etc. there, the executor and the person 2, they may not be the same person. You can have a separate one. But again, it's going to depend on there. If they want to sell, does the rules allow the beneficiary to sell, or is it solely up to the executor? So again, you just need to put that in that life interest. Jenny, can the same testamentary trust be used by more than one generation? Yep. So once you set up one of these, it can carry on down the track. And again, which is one of the reasons that we set up these living trusts. So, for example, the Family Protection Trust, we set them up in Adelaide, South Australia, so the rules against perpetuities don't apply, so they carry on, which then leads us down to this multi-generational. We can have the Bill Subtrust, which flows out of this trust, and then that can go down for generations to come, which is important. So if the FCA causes discovery of all matrimonial property, FCA orders allocate the property, including suit between the parties apart from possession shares. Why does it make a difference if the assets are held in the spouse's non-risk partner's hands? That's a really good point, but having been through a divorce, let me just put it this way. Usually when we come round to getting to the family court orders, is usually around about maybe 18 months at best case to 2.5 to 3 years before it gets to family court. Between that time, between the separation and that, there's a lot of heartache going on. You're going to find that it's more often the case, particularly in acrimonious separations, that there will be AVOs, whether they're real or whatever. You'll find that that'll be the case. There'll be clampdowns on what can and can't be spent. So that in this issue is that if the assets are in the spouse's name, the problem is, you're quite right, when it comes down to the family court 2.5 years down the track, effectively you're going to be in a position of seeing what happens. But in the meantime, you should be aware that if you don't have any financial keys to the castle, so that if I'm up here and I'm sitting out here looking at what's happening in the castle and I've got no money, then I can sit and wait for 2.5 years. But if I've got no money, no assets, nothing, then I'm going to be pleading, begging with the owner of those assets to get some financial support. So you're quite right, from the family court orders, that's the case. But again, law is about negotiation. Before you get to the family court, generally, I would say about 90 to 95% of cases end up with a property settlement. So you get to negotiation, and you can't negotiate from a position of powerlessness, if that makes sense. So again, by having it in the here, so how could it work differently? Well, we can still understand that. So we could still have, for example, our main client there, The spouse may be a secondary leading member. We can boot them out straight away, but then we're going to be the one that control. That still doesn't mean that property is not going to be caught up in matrimonial property. But again, we're going to be negotiating from a position of strength, which is what it's all about. And likewise, we can always pass it down to the next generation as well. Still might be caught up in matrimonial property, but at least it's getting far enough away from us, if that makes sense. Debbie, if we have an existing trading trust that has been in operation for years, you can upgrade the deed to a leading member yet with succession. And then this is a way to transfer the family business to the next generation. Absolutely. So that's the best way of all, Debbie, particularly if you've got that farming businesses or those multi-generational is starting to go into here, is this concept of that living trust that I've got there, that these vehicles here will basically go on ad infinitum, so that businesses' assets can be transferred between generations where there is no family provision. Now, when we talked about the family law, generally you'll find that with the family law, if we're down in this scenario here, whereby there's these sub-trusts here, so we've built it past that generation, Debbie, into the multi ones here. This won't be matrimonial property because it's being shared with a whole lot of other people. And Bill may not even be the director or the appointer or the leading member. So that in this instance, it may well be protected from family law as matrimonial property. But what it will mean is that obviously it'll still be a financial resource, being the difference. The difference in family law is financial resource is just like income and salary, which has to be shown as part of those family court orders, whereas matrimonial property is you can actually split up that property, which you wouldn't be able to do the second generation down from there. Anyway, that's we're getting towards, we've just carried on over to 1:30, but Michael, you've got a partner solution next week. What's that going to be?
I do.
In fact, I've got one for you. Can I don't know what we've gone. I've said some other stage, but I've got one that I wouldn't mind you doing with Susanna Bransgrove on, that family negotiation as well. So I know she's coming out with a course, going into that more deep dive, because we've had a lot of people interested in that. So if you've got a chance to interview her, that'd be fantastic.
Well, I know Laura's listening now and has been manning the chat. I've done a little bit of the chat, so Laura will reach out and arrange that. So we've actually been, Onusa and Laura's been fantastic. They've been arranging the next few with me. We've got some great ones coming up. Then next Thursday is with Lawrence Barlow from Credit Reboot. He's the CEO. He's the first. He talks about, we did one down in Sydney and the sound wasn't great, so we're going to do that again. I know it was, everyone was really interested in that. He talks about going from the dark side to the good side, a bit of a Star Wars analogy, in that he used to be one of the leading debt collectors in the country, and he was the first to market in relation to, Credit Reboot and refreshing credit files and things like that. They have a specific target market they do, and they assist in relation to, Laura's just put it up there. It's called The Great Debt Escape with Credit Reboot. And so we'll talk about a bit about, they work closely with EO, and we have a wholesale agreement with them in place. And so they specifically deal with, personal and individual issues, whereas EO is working with businesses in relation to insolvency and pre-insolvency and business turnaround. EO used to, until we, went into bed with Credit Reboot, we used to do that ourselves as part of, because often we'd get an individual or director who had personal issues, and we try to do it as best as I can. But Credit Reboot actually has an amazing application that reviews the Consumer Credit Act, and they're the only one in the country that does that and goes through and finds holes in relation to that, and then provides solutions. And believe it or not, in 99% of cases, there's been breaches of the Consumer Credit Act. So it's quite a good one. And then we've also got some great sessions. We've got one with a very funny lady coming up called Joyce Ong, who we're from Tax Nuggets, I think is the next one after that, and potentially a night session where we might get some Lightyear members and SAPEPAA guys and Grant, and we might have a couple of Reds and have a chat about a few different issues.
Yeah, that'd be nice. It'd be fantastic. And as I said, we've got Susanna Bransgrove. I'll have a chat with Laura about that, and we'll slot that in.
Hey,
The other one is, so just watch out very shortly for the next 2 or 3 weeks when we come out with our membership for SAPEPAA. When we do go to launch, obviously, for those of you who have already done the accreditation, that will, we're still working out the certification process, but that won't be overly extended requirements there for you. So watch out for that, because we'll be announcing who are certified advisors on that session. So anyway, thank you very much for coming, and Tone and Michael and Laura.
With some humour.
Yeah,
I just received received an email, right? I want to share it with the attendees, please.
Yeah,
coming from, you know, the session what we've just done now, it all ties in now. Can I just share this? Can you just give me the share screen thing?
Yeah, hold on. Oh, let me.
Make sure you share the right screen, Tony.
I will.
Exactly.
No.
Yeah.
Please. This is some humour just to finish off the day. That's all.
I know. Well, Tony's not well known for his skills in
his IT, so we might get a different sort of humour come up.
Just stop recording it too. Just stop recording it, just in case. I don't want this showing up, but that's all. If you can.
Let me just see. Can you share your screen now?
I can. I can. This is the ultimate, you know, this is just to finish off. Dear lucky beneficiary, congratulations, your email address has just earned you £9 million for the 22 FIFA Cup Qatar lottery. Please kindly contact our dispatching officer with your full details and your email address below for more details. Dr. Chris Newman. Well, Dr. Chris Newman, you've really made my day today, haven't you? So I will.
Yeah, I think you should send it on to some of the tax office and just say, look, this is a better one to.
And your online lottery coordinator, Mrs. Angela Williams. Thank you so much.
I know.
Mrs. Williams.
I know.
I thought I'd just put that humour in it anyway.
I don't know what you've been clicking on, Tony, to get those sorts of emails, but
exactly. I know. And it's not even it's just going straight through.
Well, just some humour for the day, just to wrap it up. That's all. You know.
Okay, let's get those loan agreements out. Actually, we'll just get some gifting deeds from Tony now he's solvent. So
no, that's it.
Okay, guys, thanks for that. Okay. And thanks for everyone attending. And I'll get this up and running up on the site with that indemnity letter as well. So see you all.